Ever wonder how a $100,000 lump sum investment would perform across different ETFs? Today, I'm breaking down the performance of some of the most popular ETFs that index the NASDAQ 100. They are QYLD, JEPQ, QQQI, QDTE, QQQ, and VGT. I will look at the past performance over the past 2 years, 1 year, and 6 months. We'll look at NAV changes, how much income you generate if you lived off the dividends, and what the income could look like if you reinvested every payout. All right, once again, this is not financial advice. I'm just doing an analysis to help you understand if you invested $100,000 and you are growth focused or income focused, what that could look like. So I'm using that straightforward $100,000 lump sum investment for each fund at the very beginning in each scenario to keep the comparisons clear and fair. The goal is to see which fund could be a better fit depending on your income needs, growth goals, or a mix of both. But first, let's give a bit of background on each ETF. They each serve a unique purpose, so the right choice depends on your goals, whether it's income, growth, or even risk mitigation. So here's a quick summary of each ETF and the strategies they focus on. Okay, first is QYLD. This is the Global X NASDAQ 100 covered call ETF. This focuses on generating high income through a covered call strategy. They sell call options on the NASDAQ 100 index while holding the underlying stocks. And this ETF prioritizes income over capital appreciation. And this is best for investors seeking consistent high monthly income with less emphasis on long-term growth. So some of the trade-offs are you can have limited upside potential due to the covered call cap, and we'll see that in the analysis. And you may see NAV decline over time, especially during bull markets, compared to things like QQQ and VGT, which we'll get into after. Next is JEPQ. This is the JP Morgan Equity Premium Income ETF, which is very popular, just like QYLD. This is similar, and they employ a covered call strategy on large cap stocks, but with active management to select options. So the targets here are for high income while attempting to capture some market upside. So they want to create income, but also see some of that growth and you don't lose some of the growth. And then this is best for income-focused investors who want higher dividends without completely sacrificing growth. Some trade-offs here, they can definitely come with higher income, but at the cost of limited upside, and it's actively managed, which may lead to variable returns. So you may see some inconsistency in the dividends. We'll get a little bit into that. Next, third up, we have QQQI, which is the NEOS NASDAQ 100 High Income ETF. This is designed for downside protection while offering a capped upside. It uses options to buffer against market drops, up to a certain degree, right? This is best for risk-averse investors who want exposure to the NASDAQ 100, but prefer a safety net against losses. This also tries to capture better tax utilization, so it gets taxed better than, say, JEPQ or QYLD. And some of the trade-offs for QQQI, growth is capped due to the buffer strategy that it uses, and then it's best used in volatile or declining markets. Okay, next we have QDTE is the Innovation 100 Zero DTE Covered Call Strategy ETF. And this is unique because this one actually pays out weekly. And this is one of the less aged. This will only be in the 6-month evaluation because it hasn't been around that long. So the strategy here, it's a defined outcome ETF. So it provides downside protection and defined upside caps over a set period, meaning 1 year. So it uses options to manage risks and returns, but like the other ones, this uses synthetic covered calls versus regular covered calls that QQQI and QYLD and JEPQ leverage. This is best for investors seeking predictable returns with reduced risk, but some key trade-offs here could be limited upside and growth potential due to some of the caps. And this is designed for short to medium term holding periods. Definitely not something that you want to hold on to long term, especially with something that has such a high distribution rate of 104. And we'll also see, there's NAV erosion that happens with this ETF. But remember, it pays weekly and the distribution rate may make up for that in terms of income. Okay, next, this is one of the go-to. The next two are kind of go-to for investing for growth investors, and that's InvestQ QQQ, which is just indexed on a NASDAQ 100. So this tracks that index, focusing on the 100 largest non-financial companies. So it is definitely growth focused with a heavy exposure to tech and innovation driven companies. This is best suited for investors looking for capital appreciation and a diversified tech heavy portfolio. So if you don't need to live off the dividends or not looking for any income, and you're definitely playing the long game, maybe you're earlier in your investing career, definitely this is one to look at. Some of the trade-offs are higher volatility compared to the broad market ETFs like SPY or VOO, which index the S&P 500, and then minimal income generation. The dividend distributions are super low. If you look at the distribution rate here, 0.65 compared to DTE, QDTE, and some of the others, even in the 9 to 10 to 12% dividend yield, these distributions are very small. Okay, and then finally, rounding out the NASDAQ ETFs that we're going to cover today is VGT, which is the Vanguard Information Technology ETF. So this focuses on exactly that information technology sector. It holds companies like Apple, Microsoft, Nvidia, those that are in the NASDAQ 100. And it's definitely targeted for growth through maybe even a more narrow sector. And then you can look at this also. The expense ratio is low. The dividend yield is also low, 0.55. S4 QQQ was 0.63, I believe. So definitely not for dividend income unless you have millions and millions and millions of dollars to invest specifically into this ETF. This is more for, again, earlier in your career, your investing career, if you're explicitly growth minded. So this is for those bullish on tech and looking for that long-term capital appreciation. Some key trade-offs here are just like QQQ, you're concentrating your risk all into the tech heavy sector, which has its ups and downs, and then it's lower diversification compared to things like S&P 500. So to sum it up, if you're looking for high income, you may be looking at something like QYLD, JEPQ, QQQI, and QDTE especially. But if you're looking for growth-oriented portfolio, then you probably want to be in QQQ and VGT. Okay, with that being said, let's go ahead and get into the analysis here. So again, we're going to be looking at 100,000 invested in 2 years, 1 year, and 6 months, and looking at the performance. Okay, so here are the stocks we have. And first, let's look at if you invested $100,000, what's the amount of shares that you would get if you did invest in it? So you would get in these two, QQQI and QDTE, they weren't around for 2 years. Don't know how the history, so they're not actually included in this 2-year analysis. So if you bought 2 years ago, $100,000 in QYLD would have roughly got you 6,253 shares, 2427 of JEPQ, 372 of QQQ, and 310 of VGT. The dividends they would have paid out per share are listed here. So if you were paying dividends per stock per year, for QYLD, they would have paid out $4.33 per stock for the year. JEPQ would have been $9.55, QQQ is $5.39, and VGT is $6.85. Okay, looking at, and I believe that was for the 2-year period. So looking at NAV change. So NAV change means net asset value. So if you invested $100,000, did that original investment increase or decrease? So in all these cases, you would have seen in the 2 years, you would actually see an increase in your NAV value. And some of that can be, due to inflation, but the thing you don't want to see is NAV erosion, where you start to see the stocks are not worth it anymore. So here's the dollar value if we want to look at it from a dollar perspective. So if you invested $100,000 in VGT on January 1st, 2023, that $100,000, because of the growth of the stock, you would now have $194,245.56. So 94% growth for that. And for QQQ, 92.41% growth. This is proving out and showing why these are for mostly growth-minded investors. So you look at JEPQ, QYLD. Good thing about these, if you invested your money, you wouldn't have lost any money across the 2 years. Now, looking at the dividend income, this is where we will see a lot of difference too. So we saw a lot of difference with the growth-focused stocks, ETFs here. We'll see also another big difference here with the income-focused. So for QYLD, if you would have invested $100,000, you would have made $27,000 over the course of the 2 years in dividend income. So roughly, $13,000 a year. So $1,000 a month. So if you would have put that $100,000 and you really needed the income to the tune of $1,000 a month, you could have gotten that by investing in QYLD. Slightly less, but similar story. So QYLD actually had the slowest growth, or the smallest amount of growth, but the highest dividends. And you'll see this, that's kind of how they correlate. If you want to get more income, you actually give up some of that growth and some of that not necessarily NAV erosion, but NAV growth. So you look at JEPQ, the dividend yield is slightly smaller, making roughly $4,000 less than you would have from QYLD, but the stock actually grew more. So after that 2-year period, you would have 138,000. So this to give you an idea of what it's like if you would try to live off those dividends. If you would have reinvested, so if for some reason, you didn't want to live off the income or live off the dividends and you want to just reinvest everything, this is a more apples to apples comparison of how they actually performed. So again, the growth minded ETFs are for the win if you don't need access to the funds right away. So total reinvestment after the 2 years, you would now have almost 200,000. So it's essentially, we did a calculation. I did a calculation in the background with reinvesting the quarterly dividends because QQQ and VGT pay out dividends quarterly and what they would have compounded to. So it's a little more than just adding the share value and the dividend. So if you would have reinvested over time, over the 2 years, you'd have almost $200,000. So you almost double your investment with VGT, and same with QQQ, you almost double your investment. And so here we go with also JEPQ and QYLD. So that's what the scenario would look like for a 2-year period. Okay, now looking at a 1-year period, what that would look like. So let's see how many shares we would have gotten. So again, QDT is not on here because it didn't start trading until March of 2024. So it's included in the final analysis, but it's not included here. So if you spend $100,000 on January 1st, 2024, this is the amount of shares you'd have, roughly 5,700 for QYLD, 2,000 for JEPQ, 2,000 for QQQI, 246 for QQQ, and 209 for VGT. And let's look at the NAV. So what would you have at the end of the 1-year period? So let's see who the winners are here. So from your original $100,000 investment, what would you have at the end of the year? So we saw a 23.72% NAV growth for VGT. So you would have 131,000. For QQQ, you saw about 21%, so 127,000. And then JEPQ, again, good here. None of these actually would have lost you money in 2024. Potentially you wouldn't have grown as much, so that would be the downside, but you wouldn't have lost, and we wouldn't have any NAV erosion, right? So QYLD would be 105,000, and QQQI, which I think launched early in January of 2024. So there's a month maybe missing, but I still wanted to include it in this analysis. So this is the dividend per share you would have been paid over that period. And then now let's look at if we lived off the dividends. So in that 1 year, QQQI is a slim winner over QYLD. So you would have gotten 13,440 in dividend income. So a little over $1,000 a month. Same thing with QYLD. JEPQ would have come in at 10,767. If you invested 100,000, the growth minded, again, these have the smallest dividend yields. So 778 and 702 respectively. And total reinvestment, if you were to just look at this again, this is the apples to apples comparison. If you were to reinvest, so all in, growth ETFs are going to perform better, but it's interesting if you look here between JEPQ and QQQ, there's only about a $2,000 difference, but look at the difference in dividend payout. So you would have gotten essentially $10,000 more in dividend payouts and only lost maybe $2,000 in growth. So this is where you can see what we talked about where JEPQ, the strategy here is to provide high income, but also to have some upside, some growth upside. So in some cases, JEPQ might have been a great investment. So if you are a growth minded or income investor and you still wanted some growth. Okay. So, and then rounding out the bottom of these QYLD and QQQI. But we have to keep in mind that 2024 was quite of a bull run year. So it could be the difference why in that 1 year, there's not a lot of difference here in how they would have performed if you spent $100,000 at the beginning of the year. Okay, so that's not to say, and I know that's not completely accurate to what people will do because lots of times you invest over time, you get into things at different times, but this is just to give a more apples to apples comparison year over year. So we're looking at 2 year, 1 year. Now let's look at the 6-month performance of these ETFs. And now we're going to be able to conclude QDTE because it did launch in March of 2024. So you'll see that it has some data in here. So let's look at number of shares. If you invested $100,000 on July 1st, 2024, you would get 5,600 for QYLD, 2,100 QDTE, 1,970 for QQQI, 1,800 JEPQ, 208 for QQQ, and 173 for VGT. Okay, now we're starting to see some negative NAV erosion here, which, is QDTE, but keep in mind that they pay out dividends weekly, and the high dividend yield, the 100%-ish distribution yield. So even though we're seeing this NAV erosion, which looks bad, let's look at it here. Let's look at what you would have had. So again, this is of your original $100,000, what would be left after 6 months. So VGT and QQQ, of course, are going to show some growth. It was a bull run last year, 2024. So I would expect to see that growth. QQQI is also showing growth. JEPQ is still showing growth, QYLD, but QDTE is showing 11.3% erosion on that original $100,000. But there's more behind the story. So let's start to look at the dividend income. So keep in mind, this is only a 6-month distribution. So in 6 months, QDTE with weekly dividends would have paid out almost $20,000 in 6 months. Can you imagine that? So that's roughly that's more than $3,000 a month. So if you are an income investor and you had $100,000 to invest, that might be something that's enticing to you to actually have this income to maybe live off of and then reinvest some of those into another portfolio, another stock. That's what I do with a lot of my yield max ETFs. I'm invested in MSTY and I'm invested in NVDY, and I reinvest those distributions into more growth minded stocks. So that's for another video. If you're interested in watching that one, I'll link it in the description below. You can also see why here QYLD, I sold out of my QYLD portfolio, but we can talk about that later. But looking at this performance here, minuscule dividends, again, like I said, if you had millions and millions of dollars and you want to invest those in QQQ, VGT, live off the dividends, more power to you. I don't think that's realistic for a lot of people that may be watching this channel or a lot of investors out there. So there might be something in this, in the QQQI, QYLD, JEPQ, and even QDTE if you are more risk tolerant and using that to invest into other things. Okay, this is another surprising thing that I found. So looking at the 6-month performance, I would have expected to see VGT and QQQ here. This is the apples to apples comparison of total value if you reinvested those dividends and didn't live off them. QYLD and JEPQ actually outperformed VGT and QQQ in this 6-month period. Now, granted, it's only a 6-month period, and most investors will invest over time. So I've had JEPQ in my portfolio for more than 2 years, QQQI for more than 1.5 years, right? And I've had VGT and QQQ almost forever. So for me, it may not compare and net out this way, but if you just invested in July, you might see better performance out of QYLD and JEPQ in that time period. So again, this is just a snapshot of 2 year, 1 year, and 6 months. If you would have gotten into it, maybe this will help you understand what your goals may be and give you some insight into strategies. Again, not investing advice. Okay, so one thing I wanted to also show you here is the performance over time in that 2 year period. I'm not going to break it out because we already went through a lot and this video is getting long. So I just wanted to show you the performance. If you did not reinvest dividends and that 2 year performance, you'll see that VGT and QQQ, clear winners. I prefer VGT. I'm more my portfolios in VGT, but I do have a few holdings in QQQ just to have that balance out. I like Vanguard funds. That's just me, not advice again, but that's just me. And then looking at JEPQ and QQQI, there's not terrible NAV erosion over that time period, so you will see some growth. You won't see your initial investment shrinking, but you won't see some of the growth just in stock price that you would see in VGT and QQQ. And then QYLD, QDTE, again, they're lagging. QYLD, like I mentioned earlier, I sold out of my positions and moved more into QQQI and JEPQ. Again, I'll share that video in the description below. You can check it out later. One thing I wanted to show you was what would it look like as the apples and apples comparison. So if you reinvested those dividends and you didn't live off the dividends, what would that look like? And interestingly enough, over that 2 year period, JEPQ actually outperformed QQQ and it's only lagging against VGT. And then actually QYLD looks like a better investment if you're reinvesting those dividends. And then you have QQQI and QDTE, right? So hopefully this gives you a little bit more information to give you some insight into what it would be like if you lived off the dividends, what it'd be like if you reinvested the dividends, and how you can approach your portfolio to meet the goals you have, whether it's growth, income, tax optimization. So again, thank you all for watching. If you haven't subscribed already, please do so. Please like the video, help me find some more folks that can benefit from this information. Yeah, and if it doesn't challenge you, it doesn't change you. Thanks for watching, and I'll see you next time.